Ba-dum-ba-dum-bum-bum. Good morning, folks. Welcome to The Street today, here from Post 35 on the floor of the New York Stock Exchange. It's Friday. That's why we start with a jingle. It's the 17th of February. I'm your host, JD Durkin. We are about an hour or so into the trading session. Stocks in mixed territory, mostly trending lower this morning as investors continue to react to hotter than expected inflation data, stoking fears the Fed will need to raise rates for longer. I also got that indication from some Fed officials who are now saying they will not take the possibility of a 50 basis point rate hike off the table. What happened to all this chatter of a Fed pivot or the Fed cuts? No one's really talking about that anymore. Wall Street is on pace for its third straight losing week. Let's take a look for what's on tap for this morning's broadcast. We will be talking economic data. Of course we will. We're all nerds for this stuff, but it's important for you to know. As investors digest sticky inflation, hot retail numbers, a historically tight labor market, plus, as if all that weren't enough, we'll talk to the central bank as the chances of a 50 basis point rate hike come back into play. And finally, we'll tell you what's going on with Tesla as the automaker recalls over 300,000 cars. For more on those stories and so much more, we now bring in our senior editor, our chief markets correspondent, Mr. Martin Baccardax. Martin, how you been? It's been a minute.
Back in the saddle. Good to see you, JD.
Nice to be with you as well. So markets are trading in, pardon me while I take a look. We back in positive for the Dow? Yeah, fractionally. The S&P down fractionally. What are some of the top factors weighing on investors on this Friday morning, Martin?
I mean, there's a whole host, really, JD. I think we're sort of bereft at the moment of a particular driver, but what we're seeing in bond yields and indeed in market volatility are probably the most important concepts that we need to navigate through today. In overnight trading, 10-year Treasury note yields hit 3.9%. That's the highest they've been since early November. And if we get close to that 4% range, and that's an absolutely key level for 10-year government bond yields, stocks are going to come under extreme pressure. But for the moment, they're trying to fight through it. Stocks are fighting the Fed in a way that is very different from the bond market, which appears to have capitulated. So I think for the most part, stocks today are looking at bond yields. They're looking at a pullback in the US dollar because we're actually retracing some of those moves higher in bond yields last night. And we've seen an uptick in equity market volatility gauges with respect to the VIX. That's the CBOE Group's benchmark sort of indicator of daily market volatility. It was over 21 points when I last saw it. That generally sort of prescribes day-to-day volatility for the S&P 500 of about 1.3%. At current levels, that's about 55 points on either side. So those are really sort of notable swings that we're seeing. There's a lot of options that are going to expire today. There's a lot of single-day options trading that's taking place as well, which is stoking some of the volatility. So that's what we're seeing, I think, in large part right now, JD. The Dow is also getting some support from Deere and Company, which had better than expected earnings and is adding, I think at last calibration, about 125 to 150 points. So that's clouding things a little bit. But I think broadly we're weaker. Looking at the Treasury yields very, very closely, the US dollar as well, and sort of now trying to pick through the tea leaves with regards to Fed policy.
Yeah, the S&P right now is at 4071 as we're having this conversation. It is off its 200-day moving average, which argues it should be 38, 39 and change. So suggests maybe there's some room to fall there. How should we read the 4071 level we're currently at as of 10:33 a.m. East Coast time on this Friday morning ahead of a three-day weekend?
There are more and more people, JD, that seem to be questioning the strength of this recent rally. It's worth noting that we are about 14 to 15% off of the October lows, and there's quite a bit of debate as to whether or not this is a sort of bear market rally. The Bank of America Fund Manager Survey, which comes out every month, and is a really important benchmark of what asset managers around the world are thinking. About 66% of those respondents describe this as a bear market rally, and they don't think it's going to have legs. Now, earlier this week, Wells Fargo said the bear market rally is actually over, and that the bear market is over, and actually stocks have more potential upside. That didn't really gain a lot of traction, it has to be said, because the hot inflation data came quickly after that, and stocks have been under pressure ever since. So I do think you're right to point to that 4100 level on the S&P 500, because it may not hold. And if we get a sustained sort of dip below the 4,000 point mark over the next few days, then stocks could really be on a drag for the next 10 to 15. And there's actually some pretty bearish calls into the middle of March as well which we need to be aware of. And then, of course, we have the Fed meeting. I think it's on the 23rd. So there's a lot to play for between now and then, but there's no question that the year-to-date gains for the S&P 500 and its rally from the October lows are being critically tested.
That's right. We'll get another meeting the end of March, then May, June, and July as well. We also got some housing data this week, Martin, showing housing starts plunging to their lowest level since 2020. Can you give me your current read on the overall state of housing?
I really thought those numbers were going to come in a little bit higher, JD, because the warm January weather had such an impact on retail sales, on inflation, on jobs, and everything else. And I assumed that that was going to roll into housing starts as well. But they can be notoriously difficult to predict, and they are dependent on, of course, very complicated supply chains. So to some degree, whilst I was surprised, I wasn't necessarily shocked. But I think the caveat in all that is that mortgage rates are still highly elevated. That's eroding purchasing power. And of course, the hawkish signals that we're getting from the Fed only suggest that mortgage rates are going to tick higher still. So if they are rising, it's going to be very difficult for the housing market to end its rollover. But we are getting near to the weakness, I think. And as a result, I think there is the potential for some sort of change, at least in that regard. But it will need to be interest rate led. That may not happen for a good few months.
It was a big week of data, hot inflation data and PPI, strong consumer sales and retail figures that we got, retail sales rather. What were some of the top points worth remembering for the week that was as we head into the weekend?
That retail sales number, JD, really leapt off the page for me. It was the biggest monthly gain in about 2 years. And we looked to have spent about $700 billion collectively over the month of January. And January is meant to be a typically weak month because we're all suffering as a result of the overindulgence of the December spending period. But that didn't appear to be the case. And it dovetailed with what we saw with respect to January jobs gains, which, of course, were an absolute blowout. 517,000 new positions and a headline unemployment rate of 3.4%. So the job market is ticking over. You and I have talked, JD, on several occasions about how many people misunderstand the connection between spending and jobs. And it's something that I think is obviously not necessarily empirically true, but it's something that we see in our everyday lives. People are confident to spend when their employment situation is deemed to be cemented. And when you see 517,000 new jobs added, you can understand why spending is as firm as it is. Now, that doesn't say, or I'm not trying to indicate, that spending is going to maintain that kind of threshold over the coming months. But I do think it's going to be more sustained than people assumed. And that's why that number for me was probably the most important driver of the market sort of sentiment this week, and why we began to understand how these 50 basis point rate hikes came into play.
We've talked a lot about how investors, at least on the equity side, not on the same page of the Fed, but it does seem as if the bond markets maybe kind of like finally bought into the Fed's promise of a higher terminal rate. Can you give me your sense on the latest there for bonds?
No, I think that's a good summation, JD. I think that we have had some capitulation in the bond market, although it took a very long time to get there. I think with the hot CPI data, the producer price inflation data, and the retail sales, bond markets really had no choice but to react when they began to hear that repetitive hawkish sentiment coming from the various members, Loretta Mester being one of them, and John Williams being the other, at least with respect to this week, both talking about a Fed funds rate that'll be well north of 5% for the bulk of the year. So we really saw upticks in 2-year and 10-year Treasury note yields as a result of that. And both of those moves, JD, for those who are uninitiated to bonds, are really mirroring what they anticipate the ultimate Fed rate will be. And if that is going to be in the 5.25 to 5.5% range, then 2-year yields will have to rise along with it. 10-year yields will also have to rise along with it. How does that trickle down into stocks? Well, the easiest way to think about it is investment plans just got a lot more expensive. If you were looking at building a factory, building a plant, hiring workers, expanding your business into overseas markets, and you need to borrow money to do it, it suddenly has become more expensive to do so. And as a result, you need to get the slide rule out and ask yourself whether it still remains economically viable. If you were making a decision at the margins and it becomes more expensive to do so, you may decide to scrap those plans. That might mean firing workers or at least freezing hiring and not adding more staff in the coming months. It may mean dropping investment plans, as I was just describing, and it could also mean retrenchment with respect to the business prospects that are already out there. So this is where it begins to trickle down in the business. We talked about it with respect to the housing market, higher mortgage costs, eroded purchasing power, fewer purchases, falling house prices. Credit card debt becomes more expensive to manage, and that's notable because we had details from the New York Fed earlier this week that we had the biggest quarterly gain in credit card debt in 20 years over the 3 months ending in December. So higher rates have implications for businesses, for the housing market, and for consumers. It is absolutely not theoretical, JD, and that's really why markets have been reacting in the way that they have and why people are mystified that stocks have not.
All right, let's talk. That's a great summation, by the way. That whole last answer should just be clipped and shared widely because I do appreciate the context. I do want to ask you about the Fed. The economy, all things considered, holding up strong despite the rate hikes. People keep spending. The numbers are out there. How much more work does the Fed have to do, Martin?
Well,
I laugh as I say it, but
it's so true. I mean, it's worth a chuckle, JD, because obviously this is really the most important question. There's a lot of people who are far more intelligent than I am about these things who are worried about the Fed going too far. Ultimately, it is a very delicate balance into attempting to land the plane with this economy. In other words, you don't want to have rates that are too low, that allow the economy to fly too high for too long, because that accelerates inflation and damages growth prospects in the long term. You don't want to raise rates too quickly because that brings the plane down onto the tarmac in that so-called hard landing, which can ultimately result in recession and therefore drive, particularly in the employment market, significant losses. So you want to thread the needle, get it gently right to where the economy comes down from its growth rate, but only gently so, protects employment, delivers price stability, but continues to carry on expanding. That's a really difficult thing to do. And there's some question now that if the Fed goes too hard and too high with interest rate hikes to tame inflation, they'll do that kind of damage to the economy. Now, you're dead right to say that the economy is flying through that turbulence just now, but there are some who say that because it is maintaining that strength at the moment, we may be in for a deeper recession as a result over the back half of the year and possibly into 2024 if the Fed doesn't change its rate path. And there's no suggestion they're going to do that just now. So that's why we have such a debate as to whether this is enough, too much, or just right.
it's like Goldilocks, right?
Totally.
The porridge is too hot, the porridge is too cold. We're looking for that sweet spot, folks. That's why we use that word a lot in terms of economics. Over the course of the last few weeks here, Martin, investors have been pricing in largely a 25 basis point hike for the next meeting. Now there's some indication it could be 50. I personally wonder if it's just kind of jawboning hawkishness because that's what Fed officials like to do. Don't get me wrong, they're united, as you've said. But I do want to ask you why St. Louis Fed President James Bullard would float the possibility of 50 the way he did.
No, and he's not the only one as well. Loretta Mester has said essentially the same thing. And in fact, she said there was a compelling case for 50 at the previous meeting. And there's quite a few public commentators out there, many of whom I respect, Mohammed Al-Arian being one of them, who made the 50 basis point case for the February meeting as well. So there have been undercurrents of that discussion, but they've really only manifested themselves in interest rate markets over the past few days. The CME Group's FedWatch tool, which we talk about frequently, now puts the odds of a 50 basis point rate hike next month at about 21%. Now, that was only 4.2% this time last month, and that is essentially nothing. So to get to 21% is pretty notable. And of course, we are also seeing the potential for further rate hikes into June. Again, about 2 or 3 weeks ago, the assumption is we'd have a rate hike in March, again in May, and then the Fed would pause. So now the smart bet is that we will have 3 more 25 basis point rate hikes, taking the Fed rate to 5.25% to 5.5%. So it stands to reason that others might say, why don't we just get it done, do 50 in March, 25 in May, and then let the data do the talking into the back half of the year. I would say that both are valid arguments, but the Fed has told us on numerous occasions that they're more focused on the destination than the pace to get there. So if you are best still out there in the marketplace and gaining traction.
So 3 more 25s. That's the best bet right now? So that's
That is
3
the
for
best
March,
bet
3
right
for
now.
May, or sorry, 25 for March, 25 for May, 25 for June, and then see where we are.
That's correct. Yeah. So essentially now the market has come to Damascus, if you will, with what the Fed has been saying about the terminal rate, and therefore we're in that 5.25% to 5% range, 5.5% range for the June meeting, and that really simply didn't exist a few weeks ago. I beg your pardon.
Sure. Help me square the circle here, because on the one hand, I understand any investors who say, well, you can't really take the Fed at its word. The Fed said all this was transitory. Now they're kind of on a different page. They're playing from a different playbook. But at the same time, they have been, in this era, since they've started raising rates, they have been incredibly consistent. And I don't think there's anything that Powell has said in any of his public comments that have really deviated from the overall plan. So which are you supposed to pay attention to? It's kind of like, fool me once, shame on me. No, fool me once, shame on you, fool me twice. Do investors think the Fed is just kind of fooling them, even if now all the conversation at long last of a potential rate cut is off the table?
There's money to be made, ultimately, JD, if you are in the minority that fights the Fed and wins. And as a result, if you're the kind of investor that needs to generate alpha, either for your own hedge fund or for your clients, then it's a bet worth making, at least on the margins. You want to have the bulk of your money in the same direction as the Fed. But to some degree, this don't fight the Fed mantra that we hear so often, I find almost as tiresome as markets hate uncertainty. JD, markets love uncertainty. That is where they make their money. That is the bread and butter. That is the mother's milk of investing and financial financial markets writ large. You need uncertainty because you need volatility, and you need volatility in order to generate the kind of returns that justify the sort of money that the best players in the world can make. So you can fight the Fed. It is absolutely possible. Now, of course, the chances are you're going to lose, because the Fed has the kind of firepower in which they can carry on in a consistent manner, even if they are deemed to be incorrect by financial markets. In other words, the Fed can stay liquid a lot longer than you can stay stubborn. But nonetheless, there is something to be said about fighting the Fed from time to time, because they're not always right. And your discussion about the transitory nature of inflation being a perfect example. So I do think that there is something to be said for it, particularly now when there's so much indecision with regards to what the data is going to bring us on the inflation front. Inflation is slowing. It's just not slowing as quickly as maybe some people would like to see. But that doesn't mean that that deceleration won't pick up momentum in the coming months.
That's right. The key word from the last press conference was disinflation, uttered many times. We may continue to hear it for quite some time. Not deflation. We're not there yet, right?
No, we're not there yet, but you're right to point that out, because he also, Chairman Powell, had that informal discussion in Washington a couple of weeks ago in which he talked about the fact that he was pleased to see disinflation even in a strong labor market. And a lot of people sort of in financial markets took that to read him being comfortable with the direction of inflation, even with that hot January jobs print. But of course, that bet was turned around very quickly after the hot CPI and PPI data. So to some degree, there is indication that the Fed would like to be able to tell us that inflation is moving in the right direction. They're just being exceedingly careful.
Exceedingly careful indeed. Our guest that we had on the show yesterday, Eddie Gabor of Key Advisors Group, said that the Fed's worst nightmare is currently playing itself out in the economy. We're going to take a quick listen to that, Martin, and I'll ask you for your reaction on the other side. Here's Eddie.
So the nightmare scenario is probably playing out right now, where they were hoping that the work that they've done would start to show and not see some reacceleration. But the worst case is the labor market stays really, really tight, and the inflation data stays very sticky, while earnings in the markets are heading in lower direction if that actually happens. Because now you could say that there is no Fed put in that environment. Again, we've been conditioned to believe that if the market's down 30, 35%, they're going to come in to save the day. Well, if the market is doing that, while the labor market is tight and while inflation is still hurting everyday families, they're going to pick CPI in the labor market over the stock market. And I think that's a worst case scenario, because then that could lead to credit events and things that we hope does not happen this year.
Worst case scenario for the central bank, Martin? What say you?
I think there's something to be said for that assessment. The only pushback that I would provide is that the Fed really only began its aggressive rate tightening about a year ago. And the lag time for many of those could be about 18 months, perhaps even longer. So we haven't seen the full effect of the early tightening, let alone those 75 basis point rate hikes that the market had to endure in the latter part of last year. So I don't know that the Fed's job, he's right in saying that the Fed's job isn't complete, but I don't think that they anticipated it would be so because of that lag effect. But what he is saying otherwise, I think, is absolutely true. The Fed is going to prioritize CPI in the labor market over the S&P 500, 7 days out of 7. There's no doubt about that. But that's largely going to be the market's own demise because the Fed has been consistent in the messaging. And just like we talked about before, you're perfectly within your rights to fight the Fed and try to wiggle through that very narrow window of opportunity. But if you choose to do that, you also have to accept the downside. And that could be played out in markets once the Fed delivers what it says it's going to do, and that's that 5.25 Fed funds rate.
Time now for the obligatory soft landing question. Martin, what's the state?
Or no landing.
What's the state of a
That's
soft landing or no land? Oh, no landing. Yeah, let's talk no landing. What does that look like?
No landing is the new soft landing, JD. So you have to keep up. Yes, exactly. No landing essentially means that the economy is going to carry on kind of at an above trend growth rate despite these Fed rate hikes. Now, this does seem a little bit prisoner of the moment because, of course, we're all operating only under the the recency bias of the January jobs data, the retail sales, and the inflation figures. It's very difficult to see how those are going to extend into the first part of the year, let alone the latter. But that really is the discussion right now: is that the economy has generated so much momentum that it may be able to fly at these elevated rates for much longer. And as we discussed earlier, that could mean that the downturn comes in the last part of this year, but it may be more deep and more damaging than we had first anticipated. But no landing is definitely the new soft landing, and it's being played out at least in recent data. And it has to be said, in the Atlanta Fed Now GDP forecasting tool, which pegs current quarter growth at about 2.5%, that's not something anyone had forecast even a few weeks ago.
Why was the forecast a few weeks ago for lower than 2.5?
Much lower, in fact, lower than 2%. And the assumption was that it was going to trend down to about the 1% level for the first quarter, despite the gains that we saw exactly in the latter part of last year. Now, GDP Now, of course, is just a running tally of the data that's coming through. We'll get PMI data next week, which may clip those readings, but nonetheless, 2.5 is a really high starting point, and part of the reason why we're hearing a lot of that no landing talk.
Which normally we would like, right? We like Goldilocks, we like 2 to 3, but Powell said no. We're kind of shooting for below trend growth there. So I didn't know that number about the 2.5. So thank you for flagging that for me. And if I didn't know, I'm willing to bet there's someone among our viewers who didn't know that as well. So thank you for that. We do have a big week of data coming up. I took a look at the report earlier this morning. I said, my goodness, we've got PMI manufacturing, we've got minutes from the February FOMC meeting, and of course, we've got PCE data coming up. What are the biggest data points you will be following in the days ahead? All this, by the way, it's just a 4-day work week, but it sounds like it's going to be a busy one. Or am I misreading this, Martin?
No, you're absolutely right. It's a packed one. I think the Fed minutes are probably going to be the most fascinating, because we are going to look for clues as to what level and to what degree that 50 basis point rate hike talk found its way into the discussions. Was Loretta Mester alone, or were there other people who, were sort of articulating the need for that 50-point hike? And if it did have some momentum, it could then revise assumptions for what happens in March. So I think the Fed minutes will be absolutely critical. The PCE data will be as well. It's the Fed's preferred inflation gauge. But I don't think it's going to show us anything different than what we had from CPI. The number to look for in that PCE data, JD, and of course we'll dig into it next week, is going to be the month-on-month acceleration at the core level. That's the most important data point, probably for the next 4 months. If it stays at 0.4% or above, that is going to cement the Fed's hawkish tone. If it's below 0.4%, then the Fed might see some progress with respect to its inflation goals and take its foot off the pedal. So those are the figures, not only for January, but for the few months going forward that we're really going to be focused on. From an earnings point of view, JD, I think without doubt, it's going to be Walmart and Home Depot on Tuesday, because that will give us the best understanding that we can get with regards to consumer spending and indeed spending forecasts from two of the world's biggest retailers.
Martin, you know how I know we make such a good team? Because my next question was about earnings. Walmart, Home Depot. We've also got, if I am not mistaken, my friend, we've got Nvidia coming up, and then we really start to get into some of the big retail names. We've got TJX. I'm a Maxxinista. I love my Marshalls and TJ Maxx shopping. I think many people out there do. Any expectation there, either on the names I just mentioned or any others in the retail space?
No, I think those are the most important ones. NVIDIA is going to be fascinating, obviously, because its chips are really embedded in that AI space. And of course, that's the word now that is on everyone's lips with regards to the tech sector. And it's, the machinations inside the ChatGPT, what it's going to mean for the Bing search engine, and what it's going to mean for Google's dominance in search, and indeed what it's going to mean for all of our daily lives when it comes to our interaction with all things technology. AI is absolutely a game changer, and it's here now, and NVIDIA is on the forefront of that. But I think the names you mentioned with respect to retail are going to be incredibly important. And like you, JD, I am a major purchaser at TJ Maxx. In the UK, we call it TK Maxx, but it's essentially the same company, and it's all about the treasure hunt. And there's nothing more that I enjoyed on a Saturday after the gym than a good hour stroll through, digging out T-shirts, socks, and God knows what else, buying about a pound of clothing and paying $12.50 for it.
Did you say TK Maxx?
TK Maxx in the UK is how it operates. It looks exactly the same.
See, there's always these little, there's all these little changes sometimes. Like you add use to words that we don't anymore, although our founding fathers did, of course. It was the same language back then. I'm a big fan of Primark. You know Primark? Primark?
I absolutely know Primark. Indeed, yeah.
Yeah, I'd be interested to see what the retail numbers look like overseas for Primark. One day we'll do that deep dive, because whenever I am in London, that's a favorite of mine. Okay, finally here, before we move on to Tesla, any particular sectors you think are poised to hold up well throughout the remainder of 2023? Obviously, we have this conversation day after all 11 sectors of the S&P were down, but there's talk of industrials, people like energy. I'm curious what you're tracking.
I think that industrials are going to be one to watch for sure, although whether or not they can sort of, generate the kind of returns that people are looking for isn't the question, but they're more likely to be a defensive sector, but one that will perform. I think, JD, the sector that will be the most important to watch in the near term will be tech, but more specifically mega cap tech, because that is what's been driving the bulk of the gains so far this year. The NASDAQ is up just fractionally over the month of February. But if you were to pair that against the moves that we've seen in Treasury bond yields, the NASDAQ should be down between 10 and 15% if you were to do a kind of historical regression. So the reason it's being held up is because investors are buying into those mega cap tech names. Many people say that that's an indication of risk appetite, and that's a good thing and a bullish sign. I am not one of those people. I actually think it's almost the opposite. The mega cap tech companies have been focused on cost cuts and efficiency for so long now that they're almost a defensive play. So I think to some degree we're getting a head fake from what we're seeing in tech stock resilience, and that may come to fruition over the coming weeks. So look at the big names, look at FANG, and look at NASDAQ. If that begins to show weakness in the coming weeks, then this rally could really face a stern test.
What great context for us there. Okay, Tesla time. The company has recalled. I'm going to do this, recalled.
Recall.
Because it kind of, recalled means something a little different for Tesla. I think people see recall and they say, oh my goodness, you're recalling all these cars. Not quite like that, but still recalling over 300,000 vehicles, warning that its full self-driving beta software may cause crashes. What else did we learn? What does this actually mean for a company like Tesla?
I think it could be really important, JD, and I think what's worth noting as well is if we're going to, sort of air quote recall, we have to air quote full self-driving, because if it isn't really a recall, it isn't really
Yes,
full
yes.
self-driving either.
They like to say it is, of course.
Yeah, they love to say that it is, but it's assisted driving at
Yeah.
best. And the Highway Transportation Administration says it actually could be at worst, because there is the risk of it driving through intersections, of it disobeying speed limits, and effectively causing accidents, some of which could be fatal. Now, the Highway Transportation Safety Administration has been at odds with Tesla for a number of years now, and this isn't the first time that the administration and the company have disagreed on the results of these data tests. But Tesla decided to recall the cars, as you say, in air quotes, nonetheless, about 362,000. They're going to do an over-the-air update of the software. They're going to do it free of charge and ultimately get what they call full self-driving back on track. Now, there's obviously a brand erosion story with regards to this, which is the case in any recall. For Tesla, it's even a little bit more complicated than that, because full self-driving, if it were to come to fruition, is one of the most important aspects to Tesla's value proposition. And Elon Musk has said as much, not only on earnings calls, but in public commentary. Essentially, what he would like to do is have a Tesla vehicle generate recurring revenue. And the best way that you can do that is through that full self-driving software, because the users will constantly pay for new upgrades, for new features, and for new services. So he is trying to turn the sale of a vehicle into recurring software revenue in much the same way that Apple does with an iPhone. And of course, this would be groundbreaking for the auto industry, and full self-driving is the key plank in that strategy. So if this fails, this changes the value proposition for Tesla completely. I'm not suggesting for a moment that full self-driving is on the verge of failure in any respect, but nonetheless, this does blunt its advance, at least in the near term. That's why we saw the stock trade off, and that's yesterday, and that's probably why investors are going to be looking at this very closely over the coming months.
Real quick here on Tesla before we move on to rapid fire. Did you see the president's tweets? I mean, it seems like at long last, the White House is kind of embracing Tesla in terms of its role of acceptance for the open EV charging network. And after a very long time of refusing to utter Tesla's name, I mean, that was a storyline. How long into the Biden presidency would it take for the president to say the word Tesla out loud? Instead, he's put in favor, of course, on sort of the legacy names, the GMs of the world in the EV space. But finally, there's a little bit of love. He says to that end, Elon Musk will open a big part of Tesla's network up to all drivers. It's a big deal, and it'll make a big difference. I don't know. What do you make of that?
There's no point in the White House picking a fight with a company that has such a cultural zeitgeist. But at the same time, President Joe Biden and this administration really have such an affinity with collective labor and indeed auto workers unions, that they are not going to be able to align themselves with Tesla too closely because of that company's allergy to anything collective with regards to unionized workers. And there's been all sorts of reporting on that and headlines that are coming out on this very day with respect to that. So it is a nice little bit of I guess, if you will, ping pong diplomacy with respect to Biden reaching out and trying to make nice with Tesla. But there's a long way to go to repair sort of relations, and they may ultimately rest on whether or not Tesla is willing to allow some unionized workers onto its shop floor, and as a result, sort of find itself more closely intertwined with the government's efforts to get us all driving electric vehicles.
Ping pong diplomacy indeed. You ever think that just like being president sounds exhausting? I mean, my God, all these points of consideration behind closed doors. Say this, don't say that word. We're not ready for you to say that word yet. Okay, now it's, oh my God, it's exhausting to follow. I can't imagine being the person doing it. All right, time now for our rapid fire section. Let's do it. Let's dig in. Place your bets up first, folks. DraftKings jumps on solid revenue outlook. What are we tracking here, Martin?
I'll tell you what, this company is now really finding its stride, isn't it, in the sports betting book. There's about 20 states now in which DraftKings can operate on a legal basis. Of course, there's all sorts of online betting as well. And they generated a really significant revenue jump over the fourth quarter, and that's without some of the more popular North American sporting events and I'm talking about the Super Bowl because that, of course, happens in the first quarter. So I think investors were impressed by that. They were certainly impressed by what they expect to happen over the coming year. They see revenues in the region of around 2.9 to 3.1 billion US dollars, with adjusted earnings along the way. This company is reaching maturity level, JD, and that's what investors like to see, particularly those who are managing money for pension funds and sort of more longer term investment. So DraftKings might be able to find its way into that conversation because it's solidified its position in a business that is now just part of the American culture.
All right, number 2, the judge threatens to jail Sam Bankman-Fried if he defies bail terms. What's up there?
I tell you what, Sam Bankman-Fried is trying to sort of thread the needle, as we've talked about on a lot of occasions, to construct his defense against the charges that he is facing with regards to defrauding investors and stealing money and commingling assets and all the rest of it. But the people who want to see him charged are saying that he's doing too many things with respect to using encrypted messaging tools, using virtual private networks, and trying to contact former FTX employees along the way, that he shouldn't be allowed to maintain his current bail conditions. Judge Lewis Kaplan was sort of minded to agree with that assessment in a hearing yesterday. He gave the two sides another week to come to terms with restrictions within that bail agreement, but he said if Bankman-Fried is still trying to talk to people through encrypted messaging, using virtual private networks and all the rest of it, this bail could be revoked very quickly, and the young man can find himself back in prison almost as quickly.
Yeah, he tried to say dude was using a VPN to watch the Super Bowl.
Right.
Right? I mean, that's what
in California, at his parents' house, apparently where there was no television. Right.
Gotta watch the Kelsey brothers on a VPN. All right, different conversation for a different day. All right, third and finally here, let's talk Man U. Could this be, Martin, the world's most expensive sports deal?
It certainly could be. The previous record is held by Chelsea. It was purchased along with debt, assets and equity and all the rest of it for about 5.2 billion US dollars. Man U could go for significantly more than that. The bids are meant to be in today, and we're hearing reporting that they're going to come from Saudi Arabia. They're going to come from U.S. private equity firms. They're going to come from a British billionaire named Jim Ratcliffe, which is a name that a lot of U.S. Sort of viewers may not recognize, but he was a founder of a chemicals group called Ineos. It's hard to say who is going to come out victorious, but they're going to have pretty deep pockets. This is one of the most iconic footballing franchises in the entire world. They've won the Premier League 13 times. They have a trophy case that essentially just dwarfs everyone else in European football apart from Barcelona. So I would imagine the price tag could reach into the 7, possibly 8 billion US dollar range, and therefore ultimately end up being the most, the richest sporting transaction in history.
I know we're about out of time, but I gotta tell you, I watched Premier League soccer on Sunday morning, and I now see why you have frequently said it is so much easier to watch those matches here in the U.S. than if you're abroad, where they essentially make you either go to the stadium or go somewhere else outside your home to watch it. I never quite understood it. You said that to me many times, but I was with a buddy watching the matches at 9 a.m. Sunday. He explained the whole thing to me, wild. So I'm sure you love living here stateside, and you could watch it all the time.
It's such a joy to be able to wake up and watch these great matches. Essentially in the UK on the Saturday afternoon, the biggest matches are not broadcast because the government would like to ensure that people are still going to the smaller grounds and supporting the local teams that are all around the region and not staying home only to watch the Man U's, the Arsenals, and the Chelseas of the world. So to be here and to see those matches live when normally they would either be blacked out or just not broadcast at all is really quite special.
And it is a business story. This is digital distribution. This is money rights. This isn't just Martin and I waxing on about sports, though we do like to do that. It all comes back to economics. The great Martin Baccardax, thank you, my friend. Nice to see you again. Enjoy your long, well-deserved 3-day weekend.
Good stuff. You too, JD. Thanks.
All right, brother. We'll see you soon. All right, that's going to do it for The Street today, my friends. Stick at TheStreet.com for more on these and all of the major market stories that matter to you. Have a great 3-day weekend, and we'll see you Tuesday. Catch you then.